Hello students, the topic which we are going to discuss today, that is IFRS 13 fair value measurement. Let's start. What is the expected accomplishment of today's session? We will discuss what is the objective of this standard. Then we will talk about the scope of this standard. Then we will talk about different important definitions. Then there would be detailed discussion about what is principal market. Then there would be detailed discussion about what is advantageous market. Then who are market participants. Then how to determine fair value. Then we will discuss about some disclosures related to the standard. Then we will talk about some past exam questions. Okay. So let's start with what is the objective of this standard. The objective of IFRS 13 is to define fair value. It means this standard gives us the guideline what is fair value. Then set out in a single IFRS a framework for measuring fair value. It provides us the framework how to measure the fair value, how to determine the fair value. Then it discusses about disclosures requirements about fair value measurement. But keep in mind, this is very important discussion. We have two major questions: how to set fair value, how to measure fair value. For this question, there is an answer under this IFRS 13 deal. How to set fair value, how to measure fair value. Then there is another question: when to apply fair value. IFRS 13 does not answer this question. So when to apply fair value will always be answered by particular standards. Okay. So IFRS 13 only describes you how to measure fair value. It never gives you the guidelines when to apply fair value model. Clear? Now, what is the scope of this standard? This standard applies when an other IFRS requires. So when to apply fair value will always be determined by an other IFRS or permits fair value measurement or disclosures about fair value measurement. In that case, you will apply IFRS 13. And even though when you have any other measurement like fair value less cost to sell based on fair value or disclosures about those measurements, we will apply what? IFRS 13. But there are some exceptions to this rule. When we will talk about share-based payments transaction, those are in the scope of IFRS 2, then we will not apply this standard. It will not be in jurisdiction of IFRS 13. When we have leasing transactions under IFRS 16, we will not apply this standard. Then when there is a measurement which is looking similar to IFRS 13, but it is different, like NRV under IAS 2 or value in use under IAS 36. In that case, over there, IFRS 13 jurisdiction will be stopped. Now, what are important definitions? First one, what is fair value? The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. When you are measuring fair value at that date, the price upon which you will receive for selling an asset or which you are supposed to pay to transfer to discharge your liability in an orderly transaction. Orderly transaction means that transaction is arm's length transaction. There is no pressure or no your consent is free between market participants. We will talk about later on about market participants. That is called fair value. Then we have discussion active market. A market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. Okay, a market in which transactions for asset and liability took place with sufficient frequency and volume to provide pricing information on ongoing basis. It means this is the market where there is a frequent transaction about the sale and purchase of that asset or liability, and the quantity, the quantum of the transaction is too much that you can get the information, reliable information about the pricing. Then we have principal market, the market with the greatest volume and level of activity for an asset or liability. If the same asset or liability is traded in 2 or 3 or 4 markets, we will talk about later on in detail, but the market which have greatest volume, quantity, that market will be considered, will be determined as a principal market, the most advantageous market. The market that maximizes the amount that would be received to sell an asset or minimizes the amount that would be paid to transfer the liability. Now, keep in mind, most advantageous market is different from principal market. This is the market where is used when you don't have principal market. In that case, this is the market which will give you the maximum amount by selling an asset, or which will minimize your amount to transfer to discharge your liability, even though after taking into account transaction costs and transport costs. We'll talk about in detail later on in further slides. Now, I have highlighted this area, the price that would be received to sell an asset or paid to transfer a liability. This is called exit price. So when you are using exit price in an orderly transaction between market participants at measurement date, that is called fair value. Okay. Now, moving towards next discussion, which is about principal market. Look, there is a possibility that different entities may have different principal markets. I would like to elaborate this concept with one example. Let's assume one entity which is a securities dealer, and the other entity is a manufacturing organization. There are 2 markets. One is inter-dealer markets, where securities are exchanged between different dealers, and then there is a retail market. Okay. Now, there is a possibility that securities dealer may deal in both markets. He has access of inter-dealer market as well as he has access of retail market. Okay. Now, in this case, security dealer is dealing in both markets, but its principal market is inter-dealer market. The reason here, he is trading in the greatest volume. So where you have highest volume, that would be your principal market. The concept which I would like to convey you, that is, there is a possibility that same entity may be dealing between in more than one markets. In that case, the market with highest volume will be considered as principal market. On the other side, manufacturer has access to retail market. He is going to sell his commodities in retail market. but he don't have access for inter-dealer market. In that case, he is dealing in only single market, so his principal market is retail market. So the conclusion is there is a possibility that your principal markets for different entities would be different. Now, when you don't have principal market, in that case, you will use what? Most advantageous market, which maximizes the amount to sell the asset, as I discussed earlier, and which minimizes the amount to transfer the liability. In that case, when you are determining your market, you are supposed to consider transaction cost and transport cost. Okay, when you are determining your most advantageous market, you will consider your transaction cost. You will subtract from your price your transaction cost as well as transport cost, because there is a possibility that your most advantageous market is physically located far from you. So you are supposed to bear some transport and transaction cost to get access in that particular market. But when we are talking about to determine the fair value for the particular asset or liability in that most advantageous market, in that case, you will not consider your transaction cost, but you will incorporate only your transport cost. Okay, so first of all, we will try to determine our fair value from our principal market. If we don't have access to principal market, then we will move towards most advantageous market. Okay, who are market participants? Buyers and sellers in the principal are most advantageous market for the assets or liabilities. So all the buyers and sellers are dealing either in principal market or either in most advantageous market. They are considered as market participants. What are the characteristics of market participants? They must have to be independent. So if there is a related party, it would not be considered as market participant. Okay, they must have a knowledge, they must have a complete knowledge about the market activities. They have a capacity, legal capacity to enter into a transaction. They can buy or sell the product, and they have willingness to enter in the transaction. So there are 4 characteristics for market participants. Any buyer or seller who is independent, who has the knowledge of the market, has the capacity to enter into the transaction, and have a willingness to enter in the transaction, will be considered as market participants. Okay, now how to determine fair value? IFRS 13 gives you the guidelines about the hierarchy of methods to determine fair value. You are expecting questions about this area, but don't overlook on the basic definitions and the discussion till now I have discussed with you guys. So level 1, when you have active market, that is the best level to determine the fair value, the most suitable method. Then when you don't have active market of that particular asset, in that case, if you have you can determine the price from the market for the asset which is similar but not identical, that will be considered as level 2 price. Then if you don't have level 2 access, in that case you will use different valuation techniques to determine the fair value, which is considered as level 3 and the weakest method, the least reliable method to determine your fair value. The level 1 is based on market participants, and level 3 is based on different valuation techniques, models. So the best method is level 1 and the least best method is level 3. Okay. Now, there is a detailed discussion about the level 1. It is when level 1 input comprises quoted prices in active market for identical asset or liabilities at a measurement date. So that the date when you are determining your fair value, it is the quoted price in active market, which could be principal market, which could be principal market, or which could be your most advantageous market. Okay. This is